So, if your doctor looked at your x-ray
Right.
and, they saw this massive, just jagged fracture right across your tibia.
Oh, wow. Yeah, a complete break.
Exactly, a total structural break. But then they told you to, celebrate because your fever went down.
I mean, you would immediately find a new doctor.
Right, you'd run out of the office.
Yeah.
Because the underlying structural damage is just staring them right in the face.
Yeah.
And yet they're popping champagne over like a secondary symptom.
Which is crazy.
It is. But right now, as we look at the financial landscape, that is essentially what global central banks and standard economic headlines are doing with our economy.
It's a phenomenal misdiagnosis. I mean, truly.
Yeah.
The headlines you see every morning, they're cheering for dropping inflation.
Right, the CPI numbers.
Exactly. They point to the consumer price index cooling off, and they just boldly declare that the worst is over.
Like we're out of the woods.
Yeah. But the underlying vital signs, like the structural x-rays of the global market, going back to your analogy, they are flashing warnings of a much, much more severe condition.
And I think that brings us to our mission for this deep dive today. Because, when you hear that the cost of living has stopped rising at this breakneck pace, your immediate reaction is probably just a massive sigh of relief.
Of course it is. I mean, everyone is feeling the pinch.
Exactly. But today, we are going to look past those standard, overly optimistic headlines. Our goal is to equip you, the listener, with the tools to bypass all that media spin.
To really see what's going on.
Right. We want you to look at where the quote-unquote smart money is actually placing its bets right now.
And we have some incredible source material for this.
We really do. We're pulling from this incredibly detailed breakdown provided by a prominent financial commentator, along with a macroeconomic analyst.
Yeah, and what's fascinating is they are looking at the exact same data as the central banks.
The exact same numbers.
Right. Specifically, they're looking at this shockingly weak inflation data, bond market yields, and the complexities of oil futures.
Which we will definitely get into.
Oh, yeah. But they are arriving at a deeply concerning, starkly different conclusion than the policymakers.
So to do this, we really have to actively challenge the prevailing narrative.
We do, because policymakers are constantly broadcasting that we are locked in this, epic battle against runaway inflation.
Right, that we have to remain vigilant against the ghosts of the 1970s.
Exactly. But if you look at the actual markets, where billions of dollars of institutional capital are on the line, they are completely ignoring that central bank narrative.
No.
They are preparing for a brutal phenomenon known as demand destruction.
Okay, so I want to establish the ground rules of what we're looking at before we dive into the weeds of the bond markets and oil futures.
Good idea.
Because when prices go down across an entire economy, the technical term for that is deflation.
Right.
And most people hear that word and think, fantastic, my groceries and my rent are finally going to get cheaper.
It sounds like a win.
It does. But our sources draw a massive, neon bright line between two fundamentally different types of deflation.
And if we don't separate them, we misread the entire economic landscape. Blurring the two is the first mistake most analysts make.
So let's break them down.
Okay, so you have to categorize them into innovation-led deflation and crisis-led deflation.
Innovation-led being the good kind.
Exactly. Innovation-led deflation is what we experience when technology or manufacturing efficiencies or, globalization just makes things cheaper to produce over time.
Like TVs. Right.
Perfect example. Think about the first flat-screen televisions in the early 2000s.
Oh, man, they were so heavy.
Heavy, clunky, and they cost upwards of $10,000.
Yeah, they were a total luxury item.
But today, you can walk into any big box store and buy a screen that is infinitely better.
Way thinner.
Thinner, sharper for $300.
Right, so the fundamental purchasing power of your money increased in that sector because human ingenuity drove the underlying costs down.
Exactly. That is the deflation everybody wants. It feels like progress.
My paycheck goes further because society got better at making televisions or smartphones or extracting natural gas.
It's the absolute hallmark of a thriving, advancing society. But then we have the dark mirror of that concept.
Crisis-led deflation.
Right. Crisis-led deflation. In this scenario, prices are not falling because some brilliant engineer invented a cheaper microchip.
Or a faster assembly line.
No. Prices are falling because the consumer base is terrified, financially exhausted, and entirely tapped out.
So they just stop buying.
Exactly. Businesses end up slashing prices out of pure desperation just to keep the lights on.
Oh.
They aren't passing on savings from efficiency. They are taking a machete to their own profit margins.
Because if they don't lower prices, they'll literally sell 0 units.
Exactly. And to really ground this, the sources dive into a historical precedent that just perfectly encapsulates crisis-led deflation.
Right, Japan in the 1980s and 90s.
Yes, Japan is the ultimate textbook case study for the psychological trap of crisis deflation.
I think a lot of people vaguely know that Japan had an economic crisis, but the mechanics of how it actually altered their society are fascinating.
They really are. So if we rewind to the late 80s, Japan was experiencing one of the most red-hot economic bubbles in human history.
Completely unprecedented.
Yeah, the narrative at the time was literally that Japan was going to buy the world.
Wow.
Their real estate and stock markets were completely unmoored from reality. I mean, to give you an idea of the scale.
Yeah, put this into perspective for us.
At the peak of the bubble, the land beneath the Imperial Palace in Tokyo,
Just the palace.
just the palace grounds, it was supposedly worth more than all the real estate in the entire state of California.
That is a staggering statistic. I mean, that valuations were running purely on euphoria at that point.
Complete euphoria, fueled by massive, massive amounts of debt.
Right.
Corporations and everyday citizens were taking out unimaginable loans to buy real estate and stocks.
Because the assumption was just that prices would never go down.
Exactly. But, as with all debt-fueled asset bubbles, gravity eventually took hold.
It always does.
The bubble burst in the early 90s, and massive amounts of leverage were suddenly exposed.
Because the underlying assets, right, like the land and the stocks, they were suddenly worth a fraction of what people had borrowed to acquire them.
Exactly. And this triggers what economists call a balance sheet recession.
Okay, let's unpack that for a second. What does a balance sheet recession look like for an average family?
Well, imagine a family realizes they owe $500,000 on a house that is now only worth $200,000.
Oh, man. They're massively underwater.
Right. Their entire psychological relationship with money flips overnight.
They go into survival mode.
Exactly. They don't take their paycheck and go out to a nice restaurant or buy a new car or upgrade their appliances.
No, they take every single spare yen and aggressively shove it toward paying down that underwater debt.
The focus shifts entirely from wealth accumulation to financial survival. And here is where the macroeconomic trap springs sharp.
What happens?
The Bank of Japan and the Japanese government, they watched their economy stalling out, so they deployed the standard Keynesian playbook.
Meaning they tried to stimulate it?
Right. They slashed interest rates to zero. They injected massive stimulus packages. They tried everything in their power to force the consumer to start spending again.
But the consumer was fundamentally broken.
Yes.
I mean, you can lower interest rates to zero, making borrowing virtually free. But if I'm already drowning in debt from a collapsed real estate bubble, I am not taking out another loan just because it's cheap.
Exactly. You're still trying to dig yourself out of the last crater.
Right.
And that refusal to engage is the death knell for economic velocity. The government creates all this cheap money, but it just sits there.
Nobody uses it.
Nobody uses it. So prices start coming down across the Japanese economy because businesses are begging people to spend.
But no matter how cheap the goods get, the consumer refuses to bite.
Exactly. The underlying enthusiasm, the inherent optimism required to drive investment, start new businesses, and grow an economy, it simply vanishes.
So Japan entered a period of economic stagnation that lasted for decades.
Decades, yeah. Characterized by this exact crisis-led deflation.
You know, it sounds like trying to start a campfire with completely wet wood.
Oh, that's a great analogy.
Yeah, I mean, you can throw 1,000 matches at it, and in
Yep.
this analogy, the matches are government stimulus checks or 0% interest rates.
Right.
But the fire simply will not catch because the fundamental environment, which is the consumer's wallet, and their psychological willingness to spend, is just too damp.
That analogy cuts right to the core of the issue. A central bank can control the supply of money, right? But they cannot mandate the velocity of it.
Can't force people to buy things.
No. They cannot force a terrified, debt-burdened population to spend. And what our analysts are arguing today is that the recent drops we are seeing in the CPI aren't the result of some miraculous technological breakthrough.
It's not innovation-led.
No. We are seeing prices cool because the global consumer is wetwood.
But see, your theory of deflation here slams right into a brick wall when we look at the actual behavior of central banks today.
How so?
Well, if the real threat is this wet wood scenario, this impending crisis-led deflation, why have central banks spent the last couple of years aggressively raising interest rates?
That is the million-dollar question.
Right. I mean, they're constantly talking about inflation as the ultimate enemy. There's a massive cognitive dissonance between the wetwood reality you're describing and the inferno that policymakers claim they are fighting.
To understand that cognitive dissonance, you really have to look at the institutional trauma baked into the Federal Reserve and other global central banks.
Institutional trauma.
Yeah, they are entirely haunted by the specter of the 1970s.
Ah, the 70s inflation crisis.
Exactly. During that decade, central bankers fundamentally lost control of inflation, and it nearly broke the Western financial system.
So they're just terrified of a repeat.
They are terrified of repeating that era. And specifically, they are terrified of a phenomenon known as second-round effects.
Okay, the sources spend a lot of time on second-round effects. Let's break down the mechanics of this domino effect for the listener.
Sure.
Because it isn't just a matter of one product getting more expensive. It is a highly contagious economic chain reaction.
It is. It operates in distinct phases. Round one is almost always an external shock, typically in energy.
Like an oil embargo.
Or a geopolitical crisis, yeah. Something that causes the price of crude oil and diesel fuel to spike aggressively.
And because energy is the foundational bedrock of a modern economy.
Literally everything you consume has to be grown with diesel tractors or transported on diesel trucks.
Right, so that energy shock immediately infects the logistics network.
Exactly. Which brings us to round two.
Okay, what's round two?
Let's look at a local service provider, maybe an HVAC repair company or a commercial plumbing business.
Okay, sure.
They have a fleet of 50 vans. Suddenly, their fuel costs for the month have doubled, and their utility bills for their warehouses have spiked. They cannot absorb those losses.
No, they go out of business.
So they are forced to raise the hourly rate they charge their customers just to tread water.
And then we hit round three.
Round three is where the inflation truly metastasizes, the goods producers.
The factories.
Yeah, the factories making the pipes, the tools, the consumer packaged goods. They are hit with both the initial energy shock and the secondary service shock from their vendors.
Oh, wow. A double whammy.
Exactly. So they raise the wholesale prices of their goods. And finally, you reach the most dangerous stage, the wage price spiral.
The wage price spiral. This is what the Fed stays up at night worrying about.
It is their absolute worst nightmare. The everyday worker looks at their grocery bill, their utility bill, and the cost of a plumber and realizes the standard of living is collapsing.
So they march into their boss's office and demand a massive raise.
Right. And the company grants the raise, but to afford the new payroll, they have to hike the price of their products again.
It's a localized, self-sustaining loop. Prices go up, so wages go up, which causes prices to go up again.
Exactly. And to monitor the specific contagion, our sources point out that central banks don't actually care that much about the headline inflation number you see on the evening news.
Right, they look at something else entirely.
They are obsessively focused on metrics called core CPI or supercore inflation.
Core CPI. Okay, how does that work?
Those metrics are designed to act as an economic thermometer. Central bankers take the standard basket of goods that make up the CPI, and they strip out the prices of food and energy.
Wait, why take those out? Those are the things we buy most.
They do this because food and energy are notoriously volatile. A drought in Brazil or a pipeline issue in Texas can cause massive temporary spikes.
Ah, I see.
By stripping those out, they are trying to see if the inflation has become sticky. Has the initial energy shock successfully infected the broader services sector?
Has it fundamentally raised the cost of a haircut, a dental visit, or accounting services?
Exactly. And if core CPI remains elevated, policymakers panic because it confirms that second-round effects have taken root.
Okay, I have to stop you there and push back on this entire framework.
Okay, go ahead.
Because honestly, the central bank's fear seems entirely logical based on basic math.
How so?
If a logistics company's fuel costs genuinely double in round one, like we said, they absolutely must pass those costs on to their customers or they go bankrupt.
True.
So how could second-round effects not happen in today's environment? If the inputs cost more, the outputs have to cost more.
That is the exact linear assumption driving central bank policy. They assume that if costs rise, prices will mechanically rise to meet them.
Right, it seems unavoidable.
But here's the flaw in that logic, and it forms the central thesis of our sources. Yes, businesses desperately want to pass those costs on.
Obvious.
They are trying to pass them on. But they are discovering that they literally cannot.
Because they are running into the wet wood.
Precisely. We've hit a threshold of elasticity. If a business tries to raise its prices by another 10% to cover its higher electricity and labor costs, the consumer doesn't just complain and pay the higher price.
What do?
The consumer completely abandons the transaction. Sales volume falls off a cliff.
They just don't buy it at all?
Right. The business realizes that raising prices to protect their margin actually destroys their total revenue.
So they are completely trapped between rising input costs and a consumer base that has hit an absolute financial wall.
It's a brutal squeeze.
Which forces us to ask a rather grim question.
Yeah.
Why is the consumer so thoroughly tapped out right now? I mean, to understand why the average household is completely exhausted, the sources argue we have to look backward.
To the seismic economic disruptions that began in 2020.
Exactly.
The events of 2020 and 2021 initiated what our analysts describe as a fundamental phase shift in the global economy.
Phase shift.
This is a critical concept to grasp. A typical inflationary spike eventually resolves, right? Prices go up, supply catches up, and prices retreat toward their historical average.
They normalize.
But a phase shift means the very baseline of the economy has permanently altered.
It's just entirely different now.
Prices didn't just temporarily spike, they rocketed to astronomically high plateaus, and they stayed there.
So when policymakers celebrate that inflation is dropping?
They are merely celebrating that prices are climbing slightly slower from a baseline that is already 30 to 40% higher than it was a few years ago.
Okay, look. I need to pause here for a second because the source material dives into some intensely polarizing territory regarding this phase shift.
Yeah, it definitely takes a hard stance.
It really does. The author takes a very aggressive, highly controversial stance on the global response to the COVID-19 pandemic.
They pull no punches.
No. They argue that the lockdowns were driven by a, quote, psychotic desire for power, and they assert the virus was deliberately engineered.
Right, and they claim these actions intentionally destroyed middle-class wealth.
Exactly. So, to be completely clear to you listening right now, regardless of where you stand on the politics, the origins of the virus, or the ethics of the public health response, we are not taking sides or endorsing these claims.
Not at all.
We are simply impartially reporting the viewpoint presented in the source material to help you understand their underlying economic thesis.
Which is that shutting down the synchronized machinery of global supply chains while simultaneously printing trillions of dollars to sustain the frozen economy created a catastrophic dislocation.
A dislocation that we are still paying for today.
Exactly. The source actually contrasts this with the 1918 Spanish flu.
Oh, right, noting that even with 30 to 50 million deaths globally, the economy wasn't shut down in this manner.
Right. Setting aside the political framing entirely, the pure mechanics of a synchronized global economic shutdown, followed by an unprecedented injection of M2 money supply, created a massive distortion.
You had factories offline.
Ports congested.
Shipping containers completely out of position. Supply basically collapsed.
Simultaneously, consumers were handed massive amounts of liquidity and told to stay home. Demand for physical goods just exploded.
And that mismatch created the phase shift in prices.
Exactly.
So how does this abstract macroeconomic phase shift translate to the reality of the consumer today, like on the ground?
The sources use a fantastic microeconomic example for this. It revolves around Walmart and specifically the pricing of Twinkies.
Twinkies.
Yeah, it perfectly illustrates the anatomy of demand destruction. Think about how the average consumer has survived the last 3 years.
Okay.
When the phase shift happened, the cost of rent, utilities, insurance, and basic groceries jumped permanently. But wages did not rise at the same rate.
So there's a gap.
A massive gap. To maintain their standard of living, the consumer first burned through whatever pandemic-era savings they had accumulated.
And when the savings accounts hit zero,
They turned to credit cards. They essentially papered over the price increases with high-interest debt.
oh man, we saw the data on this, didn't we? Credit card balances surged past $1 trillion.
Yes. And the utilization of buy now, pay later services for basic groceries skyrocketed. But credit limits are finite. Eventually, you hit a hard wall.
You just run out of runway.
You hit the absolute limit of borrowing capacity. And that is exactly where the Walmart example comes into play.
Okay, walk us through it.
Walmart's internal data is faster and more accurate than almost any government metric. Suddenly, their analytics show that the sales volume for discretionary middle aisle items like a box of Twinkies is collapsing.
So people aren't buying the snacks.
The consumer is walking in, looking at the price, realizing their credit card is maxed out, and putting the snack back on the shelf.
Yeah.
They are buying rice, beans, and the absolute necessities and nothing else.
So Walmart is staring at a collapse in volume.
Yeah.
What is their immediate move?
They discount the item, they lower the price of the Twinkies.
Right. And if you are a central banker or a traditional economist looking at a spreadsheet, you see the retail price of goods at Walmart dropping, and you declare victory. You say, look, deflation. We beat inflation.
But the motivation behind the price drop is what actually matters here.
Right. They aren't doing it to be nice.
Walmart isn't lowering the price out of generosity or because flour and sugar suddenly got massively cheaper. They are lowering the price out of pure desperation to maintain some level of sales velocity.
And this desperate move initiates a deeply destructive economic cascade.
It really does.
Let's follow that cascade all the way down, because this is where the danger of crisis-led deflation becomes incredibly real for the everyday worker.
Okay, so Walmart lowers the retail price of the Twinkies to entice the exhausted consumer.
Got it.
But remember, Walmart's own input costs, the wholesale costs from the manufacturer, the diesel fuel for the delivery trucks, the electricity for the massive supercenter, those costs are still stuck at the elevated phase shift baseline.
Right. So by lowering the price they charge the customer, without a corresponding drop in their own costs, Walmart's profit margins are dramatically compressed.
And a retail giant operates on razor-thin margins to begin with.
Exactly. They can only absorb that squeeze for so long before they have to defend the profitability of the company. They have to cut internal costs.
And in almost any business, what is the largest, most immediate lever you can pull to reduce fixed costs?
Labor.
It is labor. Walmart is forced to freeze hiring, cut worker hours, shift full-time employees to part-time to avoid paying benefits, or initiate outright layoffs.
Wow. And then you follow the worker who just had their hours cut in half.
That worker is now facing a severe personal liquidity crisis.
They literally don't have enough money.
Exactly. So that Walmart employee who was already struggling with phase shift prices now has significantly less income.
So they pull back.
They can no longer afford to take their family to the local independent restaurant down the street. They stop buying shoes from the local boutique.
So now the local restaurant sees their sales volume collapse.
The restaurant owner is facing the exact same margin compression Walmart faced, but they don't have billions in cash reserves to weather the storm.
No way. The restaurant owner tries to run promotions, tries to offer cheaper menu items, but the local consumer base is broke.
So eventually, the restaurant has to fire its wait staff or close its doors entirely.
And those unemployed waiters can no longer pay their rent, which squeezes the local landlords, who then default on their local bank loans.
This localized death spiral is the literal manifestation of demand destruction. It moves like a contagion.
That is terrifying. On the surface, the headline CPI might look fantastic because prices are falling, but underneath, the economy is hollowed out by the systematic destruction of consumer purchasing power and employment.
It becomes incredibly clear why you can't just flip a switch and reset the economy back to 2019.
Yeah, the sources bring up a really visceral analogy here. Untangling this economic mess is not like scraping a frozen piece of gum off the bottom of a desk.
No, it's so much worse than that.
It is like getting worm gum mashed deep into your hair.
Yeah.
Or like a cancerous tumor.
Right. You can't just pull it out. You have to painstakingly cut it out, strand by strand.
The supply chains might be physically moving again, but the debt burdens have fundamentally shifted. The cost basis for every industry is permanently altered, and the consumer psychology is entirely defensive.
The structural damage is just profound. And this brings us to a massive inflection point in our deep dive today.
Right.
We have the central banks pointing to the X-rays and screaming that they see second-round effects and a repeat of the 1970s wage price spiral.
But we have the businesses on the ground, like the Walmarts and the local restaurants, experiencing the brutal reality of the wet wood and demand destruction.
When the theory completely contradicts the reality, you have to look at the scoreboard.
You have to look at where the actual financial experts, the institutional players managing trillions of dollars, are placing their bets.
Yes. This is where our sources direct our attention away from political speeches and directly into the mechanics of the bond market.
Specifically the TPS market, right?
Exactly. If you want the unvarnished truth about what the market actually expects, you cannot listen to what policymakers say. You have to look at how capital is allocated.
And the TPS market is one of the purest barometers of macroeconomic expectation in the world.
It really is.
So let's define TPS clearly for you listening. It stands for Treasury Inflation Protected Securities.
Yes. Simply put, these are government bonds issued by the U.S. Treasury that are specifically engineered to protect the investor from inflation.
How do they do that?
Well, with a normal nominal bond, you get a fixed payout. If inflation surges to 10%, the purchasing power of your fixed payout is destroyed.
Right. Your money is worth less.
But with a TPS bond, the principal value of the bond adjusts upward with inflation. If inflation goes up, your payout goes up.
Oh, I see. It's essentially an insurance policy against the exact 1970s scenario the central banks are terrified of.
Precisely.
So logically, if I am a billionaire hedge fund manager, and I genuinely believe the Federal Reserve is correct, that inflation is sticky, that second-round effects are taking hold, and that prices are going to spiral out of control, I am going to aggressively buy TPS to protect my portfolio.
You would back up the truck and buy every TPS bond you could find.
So how do we tell what they're actually doing?
To gauge the collective anxiety of the market, analysts look at a metric called the break-even rate.
Break-even rate. That sounds a bit technical.
It can sound technical, but the concept is actually pretty straightforward. The break-even rate is the difference in yield between a standard nominal treasury bond and a TPS bond of the same maturity.
Okay, so what does that difference tell us?
It represents the exact rate of inflation the market is pricing in. It's basically the premium investors are willing to pay for the inflation insurance.
Oh, I get it. When the break-even rate is rising rapidly, it means the market is terrified.
Exactly. Investors are crowding into the trade, demanding protection because they see an inferno coming.
But when the break-even rate falls quickly, it is a massive, flashing red light.
It means institutional investors are dumping their inflation protection.
Because they don't think they need it.
Right. They are looking at the macroeconomic landscape and concluding that inflation is no longer the primary threat.
And the data points highlighted by our sources are undeniable here. They show that since late May and June, these break-even rates haven't just drifted down, they have absolutely plummeted.
Plummeted. The market is aggressively shedding its inflation insurance.
But there is an even more crucial, highly technical detail here that the analysts point out.
Yeah, the inversion.
Right. The 10-year break-even rate has actually dropped lower than the 5-year break-even rate.
That inversion is a phenomenal insight from the analysts. And it really requires a bit of translation to understand just how dire a signal it is.
So translate it for us.
When the 10-year rate is lower than the 5-year rate, the market is making a very specific structural bet. These institutions, with billions of dollars on the line, are predicting that any short-term bump in the CPI...
Like, say, caused by a temporary geopolitical spike in oil.
Right. They are predicting that short-term bump is entirely a mirage. They are betting that over the long term, inflation is going to be virtually non-existent.
Because the looming macroeconomic slowdown is going to crush consumer demand so violently.
Exactly.
It's like being in the studio audience of a high-stakes game show, and you poll the audience for the answer. But this audience isn't random tourists. It consists of highly educated, ruthlessly pragmatic investors whose entire livelihoods depend on being right.
It's the ultimate skin in the game.
Now, the bond market isn't infallible. It can get things wrong, but it cuts straight through the media spin. When a politician stands at a podium and declares that inflation is public enemy number one, but the TPS market is actively selling off its inflation protection, you have to follow the money.
Capital doesn't care about political narratives.
No, it doesn't.
In the TPS market, the capital is screaming that demand destruction is imminent.
Because they're looking at the exact same data we just discussed.
The maxed out credit cards, the exhausted savings, the margin compression at major retailers.
And they're concluding that crisis-led deflation is the dominant gravitational force in the economy right now.
Okay, I have to play the ultimate devil's advocate here for a second.
Go for it.
Your theory of demand destruction and the TPS market data makes sense in a vacuum. But I read the news today, and I am seeing active, kinetic conflicts in the Middle East.
Right.
I am seeing blockades in the Red Sea. I am seeing serious escalating geopolitical tension that historically has always led to a massive shock in oil prices.
A huge spike, yeah.
So if the TPS market is so confident that deflation is coming, how do they ignore the fact that the cost of energy might skyrocket tomorrow? Doesn't that prove the central banks are justified in their panic?
It is the most logical counterargument to the demand destruction thesis. It really is. A war in the Middle East has traditionally equaled an oil supply shock, which basically guarantees inflation.
Exactly.
But This is where our sources introduce a truly fascinating discrepancy, a literal twist in the oil market futures curve.
Oh, the futures twist. This is brilliant.
Yeah. Before you explain the twist, let's make sure everyone listening understands the architecture of the oil futures market.
Good idea. We aren't talking about the price of gas at the pump today.
No. When traders deal in oil futures, they are buying contracts that obligate them to purchase crude oil at a specific locked-in price at a specific date in the future.
Yes, it allows airlines, shipping companies, and refineries to hedge their costs. You have a whole spectrum of these contracts stretching out over months and years, which forms a curve.
And to see the twist our sources identified, you have to compare the two ends of this curve.
Right. First, you look at the front end. These are the immediate delivery contracts, meaning you are buying oil to be physically delivered next month, say in August.
Okay, so if I am a refinery manager and my inventory is completely dry, I am desperate for that front-end contract.
Exactly. And the data from our sources shows that the front end of the curve is elevated. Prices for immediate delivery are up nearly 2%.
Which completely aligns with the geopolitical news.
Right. There is active fear in the market right now that a tanker might get sunk or a strait might be closed, so buyers are scrambling.
They're willing to pay a premium to secure whatever physical oil is available immediately.
The front end is reacting to the immediate geopolitical friction. But here is where the narrative breaks down.
Okay, what happens?
If you look further down the curve, what we call the long tail, specifically contracts for delivery in November, which is just 3 months away, those prices are actually down.
Down. Let me make sure I am grasping the magnitude of this.
Yeah.
The market is saying, we are terrified enough of the current blockades that we will pay top dollar for oil today. But we firmly believe that in just 90 days, oil is going to be significantly cheaper.
Yes.
Why would they bet on that? I mean, if the Middle East is a powder keg, shouldn't November oil be priced at a massive premium too, out of fear that the war escalates?
You'd think so. But if you connect the oil curve back to our discussion about the tapped-out consumer, the twist makes chilling sense. The commodities market recognizes that the global macroeconomic foundation is incredibly fragile. Let's run the scenario.
Okay, let's run it.
High oil prices today at the front of the curve immediately translate to high retail gasoline prices at the pump. Let's say the national average hits $4.30 or $4.50 a gallon.
Ouch. And for the consumer we described earlier, the one who just maxed out their credit card to buy groceries, the one whose hours just got cut at Walmart, that $4.50 a gallon isn't just an inconvenience.
It functions as a massive regressive tax on their existence.
It immediately vaporizes whatever microscopic fraction of discretionary income they had left.
It's gone. When it costs $100 to fill up their tank just to commute to their reduced-hour job, they immediately initiate austerity measures.
They cancel the weekend road trip.
They stop buying retail goods that need to be shipped across the country.
They stop going to restaurants.
Exactly. The high oil prices of today actually serve as the catalyst that accelerates demand destruction across the United States, Europe, and Asia.
And when you mention Asia, the sources dedicate significant analysis to China.
Yes, China is the massive elephant in the room regarding global energy demand.
Because China isn't just a manufacturing hub. They are traditionally the engine of global commodity consumption.
You cannot analyze the long tail of the oil curve without understanding China's internal crisis right now. Our analysts point out that China is currently enduring a profound structural economic sickness.
A sickness that is deeply tied to the monumental collapse of their real estate and property development sector.
We have all seen the headlines about companies like Evergrande defaulting, but I don't think people realize how intertwined Chinese real estate is with global diesel and oil demand.
It is the primary engine, right?
It was a massive Ponzi-like structure. Developers pre-sold apartments before they were built, used that cash to buy more land from local governments, and started more projects.
Just constantly building.
And when that bubble finally popped, construction ground to a halt. You have entire ghost cities of unfinished concrete husks.
And when construction stops on a continental scale like that, the demand for the raw inputs collapses.
Exactly. You no longer need thousands of diesel-powered cargo ships bringing iron ore from Australia.
You no longer need fleets of diesel dump trucks and excavators moving earth 24 hours a day.
The industrial machinery that literally burns millions of barrels of oil has been shut off.
And the sources noted an absolutely fascinating data point about Chinese behavior right now.
Oh, this is wild.
Despite the geopolitical tension in the Middle East and the threat to their own maritime supply lines, China is not aggressively consuming oil to fuel their factories.
They are buying oil, but they are just pumping it straight into their strategic storage tanks,
They are hoarding the energy, not burning it, to create economic growth.
which is a staggering indicator of macroeconomic paralysis.
Really?
Yes. For 50 years, macroeconomic textbooks have treated energy demand, particularly for oil and diesel, as highly inelastic.
Meaning it doesn't change much based on price.
Right. The assumption was that regardless of the price, businesses still have to ship goods and people still have to commute. Demand might dip slightly, but it rarely collapses.
But the twist in the oil curve, combined with the data out of China, is showing that this historically inflexible demand is actually shattering.
It's breaking apart. The traders pricing November oil are looking 3 months into the future and saying the U.S. consumer is completely broke, the European industrial sector is stalling out, and China's housing market is a black hole.
So even if supply from the Middle East remains incredibly tight, there simply will not be enough global economic activity to sustain high oil prices.
It is an astonishing multi-billion-dollar bet against the long-term necessity of oil, and it completely defies the surface-level panic you see on the evening news.
When you synthesize it, the smartest money in the commodities market is in complete agreement with the smartest money in the treasury bond market.
Demand destruction is the inescapable gravity that is going to pull the entire global economy down.
Wow. Okay, so let's bring all these complex threads together. What does this deep dive actually mean for you, the listener, as you navigate this economy? We have covered a massive amount of ground today.
A ton of ground.
We started with a seemingly simple question. Isn't a dropping CPI a reason to celebrate? And what we have uncovered is that falling prices are not a victory lap if they are being driven by a fundamentally broken, tapped-out consumer base entering a phase of crisis-led deflation.
We have to fundamentally reevaluate the baseline of our economy. The 2020 COVID phase shift permanently altered the cost structure of living.
Prices are staggeringly higher than they were in 2019.
And the debt burdens required to survive that shift are much heavier.
And while the policymakers and central bankers are running around looking at the X-rays and terrified of the 1970s wage price spirals and second-round effects,
The actual structural data shows a completely different reality.
right, the institutional investors trading trillions in the TPS market and the commodities traders pricing the long tail of the oil futures curve are all bracing for severe compounding demand destruction.
This is exactly why we do these deep dives. In an environment that is utterly saturated with political spin, contradictory headlines, and central bankers attempting to manage public psychology through fear.
You need a reliable compass.
You do. By understanding these highly technical, specific market signals, like interpreting a break-even rate inversion or analyzing a futures curve twist, you empower yourself to manage your own financial expectations.
You can safeguard your family's finances and read the true, unvarnished health of the economy far more accurately than you ever could by watching a standard news broadcast.
You don't have to be a Wall Street hedge fund manager, but knowing that the most educated audience in the world is quietly voting for a massive macroeconomic slowdown allows you to prepare your own household balance sheet for the reality of what is coming.
Rather than the fantasy of what policymakers hope will happen. Which brings me to a final provocative thought I want to leave you with today.
Okay.
It is something to mull over that builds on this entire comparison that central banks keep making to the 1970s. When the global economy went into the brutal 1973 oil embargo, the average American consumer was coming off the back of 2 solid decades of rising real wages.
They had a lot of momentum.
They had immense, deeply ingrained cultural optimism following the post-war boom of the 50s and 60s. Even though the inflation shock of the 70s was financially brutal, the consumer was structurally incredibly resilient.
They had a massive cushion of savings and equity to fall back on. They
Right.
entered the trauma from a position of relative strength.
Right. Now look at the reality of today. The modern consumer has faced nearly 3 decades of essentially stagnant real wages, the hollowing out of the middle class, the gig economy, and the 2008 financial crisis.
All of that.
All before getting absolutely hammered by the 2020 COVID phase shift and the subsequent inflation spike. Think back to our medical X-ray metaphor from the very beginning of the show.
Oh, wow. Yeah.
If the 1970s consumer was a healthy, dense bone that suffered a sudden, violent fracture from an oil shock, what we are looking at today is a bone that has been silently hollowed out by economic osteoporosis for 20 years, before the trauma even occurred.
That's a stark comparison.
If the psychological and financial starting line for this current generation is not post-war optimism, but rather absolute grinding financial exhaustion, how is this going to permanently alter the way society approaches spending, saving, and our fundamental trust in the economic system for the next 50 years?
It is a very heavy systemic question.
It is, but it is the honest reality of the X-ray we're looking at.